Jansen. And before I do want to give a shout out to John, our admin here, for putting this all together for us. John's our back end. If you ever call the phone numbers for the RIA 347-2443, that goes to John. John handles all of our advertising, marketing, all the back end, and membership. So thank you, John, for putting this together for us tonight and staying up late. But Dylan, you're the man, the myth, legend. How about you take it over?
All right, thanks so much, Ted. I just want to say good evening, everybody. Thank you so much for jumping on the webinar. It's absolutely a pleasure for me to speak to you guys. It's really exciting for me to be able to present to the Omaha RIA group. I've just been blown away. I haven't been a member of the RIA very long, just a handful of months, but honestly, just super thankful to Ted and his leadership, building this community and just having this impact on Omaha. So Ted, thank you so much. John, thank you for tolerating my I guess my handicap for technology. So I really appreciate your help. John's the man. But we're gonna dive right into it. So just a little bit about me before we get into this. Before we get into the topic, just you guys kind of have an idea of where I'm coming from, my experience, my industry a little bit. I'm hoping today you guys hear some things you probably haven't heard before, at least maybe not from a financial advisor or financial planner. And these are some of the I don't want to call them modern. It's more like a modern twist or a modern concept on a very old strategy, a very old type of account. So we're going to have time for questions at the end. I know you guys are probably going to have questions along the way. So I believe, Ted, just put it in the chat. And then at the end, we'll get a chance to kind of dive into those. I'd love
Yeah.
to take questions throughout the presentation. The problem is we have a tendency to go on a lot of tangents. And it's really hard to get back from where we started when that happens. So I want to make sure we kind of get the 101 done today. Um,
Plus, it keeps
but
people on until the end.
yeah, we'll get the end. So, I grew up in Aurora, Nebraska. I grew up farming about 2 hours west of Omaha. My wife and I now we live in Papillion, Nebraska. We've been in the Omaha area for about 10 years, and we're celebrating. Just in a couple more days, it'll be our first baby girl's 8-month birthday. So, kind of got a lot of new stuff going on. But I've been in the industry, like I said, for right about 10 years now. I've worked for a couple different companies. I was one of the founding partners with Legacy Insurance Group and Focus Wealth Management in 2019. Now we're an independent brokerage agency, so we are completely unaffiliated. We represent our clients, and it's our job. We have a fiduciary responsibility to our clients to make sure they have the best information possible and access to the best financial companies or insurance companies, whatever we're looking for. We have agents and advisors that specialize in all areas of home and auto, commercial, employee benefit plans, health insurance. We kind of do it all. My segment is the wealth building and financial planning space. But in the banking, the infinite banking strategies, one thing when I think about what's most important for the Omaha RIA to understand, or what's the real value add, I have a very small real estate portfolio. It's one of my favorite investments is my real estate business. It's definitely my best ROI. But one thing that at least I've noticed, and maybe it's just because I'm not very good at it yet, but real estate's been very competitive. For what I've been doing, it's been a very competitive space. And financial strategies like infinite banking might be just that thing to give you a little bit of an edge on that competition to get you access to more deals or just increase the value of your dollar, get your cash working a little bit harder for you to open up new windows and new profitability for your business. So infinite banking is a concept that we're going to be talking about. Okay. Now, this is the number one most Googled financial term since 2020. Really, when all the talk about inflation and then with interest rates going up in 2022 has really exacerbated the interest in how do we get our cash to work harder than it is for us when it's at the bank. That's really the crux of what makes this term so intriguing to so many people across the country. Now, for all the information on the internet, you got your TikTok experts and your Instagram influencers and all the YouTube channels spouting a lot of confidence and a lot of information, but a lot of it lacks some wisdom. I'll be the first one to say infinite banking is not a one size fits all, always a home run strategy for people. It's kind of like a really nice car. You have to take care of it. You have to know how to use it. You can absolutely get into a car accident if you don't know how these accounts really work. So I wanted this time that we get together, this 35, maybe 40 minutes that I have prepared for you to hopefully clear up some of the misconceptions, give you guys enough content that you feel like you grasp the concept and you know how to really engage with it and know if it's maybe right for you or maybe it's something that is better left alone. But I mentioned before, the best ROI I've ever had of any investment has absolutely been in real estate. So my business partner and I, we have a little bit of a experience flipping some homes. We'd like to get into more long-term rentals. But one of the ways that we're preparing for the moves to make in the future is by stacking cash inside infinite banking accounts so that we're going to be better prepared to make those moves in the future. So you guys might have, if you guys have friends who are financial advisors, or if you've talked to your financial advisors about real estate, there's a lot of friction between financial planners and the real estate industry. And to me, it kind of looks like a lot of financial advisors don't like seeing their clients put their resources in places other than the market where they can charge them fees. It kind of seems like that sometimes. Infinite banking in this concept is a really nice synergy that you can actually use financial tools to accelerate your real estate business. It is not meant to replace your business, whether it's real estate or not, right? These tools are very popular, not just for real estate investors. That's what we're mostly going to talk about today, but also just for small business owners. Like from my background with farmers and ranchers, it's an amazing wealth protection tool as well as a wealth acceleration tool. So I'm going to talk about kind of what the infinite banking concept is, the benefits that we receive from these types of accounts, who is using the concept and having the most success, and lastly, possibly how to build your own infinite bank. And then I'll finish up with a couple of real life examples. So I think we should move pretty quickly. We'll have plenty of time for questions. So the first one is, why do people use infinite banking? And the first one is risk-free. Now, in our industry, risk-free means we do not have to worry about market downturn or correction causing any loss of value to your account. So all the dollars that are inside of an infinite banking account, if the market crashes 30, 40, 50%, the money that's in that account is 100% guaranteed safe to never lose value due to market loss. It's 100% protected, no different than the money at the bank, whether it's in a checking account or a savings account. But we are able to earn market-like returns. So and I've got a really nice graph I'm actually going to flip over to real quick. So everybody's heard of compound interest, right? We all know you put money into an account, you earn interest on your money, you earn interest on your interest, that's compound interest. What a lot of people don't realize is that it's actually built on a mathematical formula called the rule of 72. It's crazy to me that we go to school for 12 and 16 years, and most people that I talk to or who come to our workshops have never heard of this very simple mathematical formula. The rule of 72 says whatever your interest rate is, divided into the number 72 will tell you how many years it takes to double your money at a certain interest rate. So as a really easy example, let's say we're earning 1% interest. One goes into 72 times, right? So that means if our money's earning 1% interest, it's going to take 72 years for our money to double in that account. Now, if these are the most common places we see our clients saving money before making a big purchase, whether it's real estate or in their business, they're buying a property or a building, checking accounts, this is the averages. I know you can find better interest in some CDs and savings accounts today. The high-end savings accounts around 5.5 is kind of what I've seen. But you can see how long it takes at the kind of the average, the common interest rates that we see at the bank. It's not for wealth building, right? Even the average CD offering 3% today would take 24 years for it to double just one time. Infinite banking, if you look at the average over the last about 15, 20 years, has averaged around 8%. Now, what our goal is in those accounts is to be around 5 to 7 net of all expenses, costs that are associated with the account, which I will talk about in just a little bit. But you can see how if we're not really paying attention to these things, it's really easy to kind of get left behind. Another really big takeaway is that these infinite banking accounts do earn interest tax-free, which we'll get back to our list of pros here. So tax-free growth, which means the interest that we earn in that account, we do not have to pay income taxes on. So we're able to defer those taxes. We can keep all the money in the account. We have tax-free access forever and whenever. If you guys are familiar with IRAs, 401ks, Roths, we call those qualified accounts or retirement accounts. Those are not where you can save up money typically in order to make a play into real estate, right? Those accounts lock up your money until you're 59 and a half. Otherwise, you've got IRS penalties and typically income taxes if you take the money out. So it's not very effective if that's where you're hoping to stash money for the kind of the liquidity that you need to run your business. So within infinite banking, you have access to it immediately, 100% tax-free, not just the money you put in, but also the money that you earn within the account. Tax-free wealth transfer, when you pass away, it actually bypasses probate. It bypasses creditors. It goes directly to your beneficiaries. It's 100% protected. You have incredible control with this account. So you're able to actually allocate the funds into how do you want them to be earning interest in real time throughout the year. So your money's not locked up. You're not kind of stuck with one thing or another. This is kind of the part of the presentation can start to feel kind of heavy, but it's all going to kind of round out here once I kind of get through this list. Liquidity, this is the biggest one. So with a lot of people try to do what we do with an infinite banking account with market-based accounts. And you can earn really good returns doing that. But the problem is a lot of times when it's the best time to buy in the real estate market is right when the market drops, right? And so if that market drops, it's going to reduce your buying power right when it's time to buy. So we go back to the first benefit here, which is that risk-free feature. Absolutely essential. You can't really do this effectively if you're not protected from those downturns, because those downturns are usually the best opportunities. Buy low, sell high, right? These accounts give you the ability to actually leverage your cash or loan against it. And so you can have your money working for you in two different places, earning interest and also working for you on a project or on a property. Those loans have no required repayment. They are not required to be paid back to the account. So it's absolutely free and clear. It's your money to use however you want to. Now, legal protection, I actually have to be careful getting too deep into this. Every state's different on what kind of legal allowances are put onto these types of accounts. They are more protected than your IRAs, 401ks, and any money at the bank. But if you get into a sticky legal situation, it is going to ultimately boil down to the possibly somewhat subjective views of your judge. It is more protected than most accounts. But it is not perfectly protected. So again, that's more of an attorney question, but it is something I want to bring up, is that there are protections within infinite banking. So we already talked about the impact of earning respectable interest, right? So with infinite banking, there's a couple different ways that you can earn interest. The one that we find is most popular and it has the most, let's just call it horsepower on the account. It's called indexing. An index account is not an index fund. A lot of people have heard of index funds. Those are mutual fund products. They're going to go up and down with the stock market. They often have advisor fees attached to them. An index account is much more like a savings account at the bank. But instead of having your interest rate determined by the board of directors, your interest rate is determined by a stock index like the S&P 500 or the Dow Jones. It doesn't really matter because your money's not actually going into those indices. It's sitting safely in a holding account, just like a savings account. But then after a year goes by, whatever that stock index did, whether it was 6, 7, 8%, that's what you get credited to your index account. Meanwhile, your money was sitting safely aside the entire time. If the stock market ever goes down, anything below zero, you are absolutely protected with a 0% floor. So you can never lose any money you've put in or any money that you've earned. So your graph kind of looks like an escalator, just goes up and sideways, as opposed to a roller coaster like a market account would. Does that make sense? And again, we're not anti stock market at all, but we understand that what we're not trying to do is hit home runs with this account. We're trying to beat the bank and multiply your cash so that you can leverage it better into your business. This is not about earning 12, 14% in the market. We have other accounts for that, right? This is so that you can leverage it into better deals, bigger business, more properties, accelerate your business. So how does this all happen? We just went through a whole list of all the benefits that we get with this account, and most people have never heard of it. So in order to get all of these benefits, let's see, we have to have a golden ticket. Now, we've all either read or watched Charlie and the Chocolate Factory, right? Everyone's already some level we know about this story, right? So old Charlie can't go to the chocolate factory unless he gets his golden ticket. So in order for us to get all these benefits, we actually have to have a life insurance policy issued by one of these financial companies. Now, the moment I say life insurance, a lot of people just kind of turn off their brains. They're like, all right, I'm out. It's an old product with a very modern and exciting twist to it. So this golden ticket, we're basically what we're doing is we're buying the IRS tax code on how they treat money that comes from a cash value account. Does that make sense? So these accounts are built to minimize any cost of insurance and all those expenses. It maximizes the value of your cash. And we're going to get into some details here in just a second on what that actually looks like. And this is where already you can kind of anticipate where these accounts can go wrong if you're working with the wrong advisor. Absolutely, where I said, you can wreck a really nice car and ruin it. You really got to know who you're working with on this. You really got to make sure you trust your advisor, because these things are niche. They are specialty types of accounts. If you're not working with someone who does them regularly, it's really easy to mess up. There's about 600 life insurance companies. Only about 3 to 5 of them, I would say, are equipped to do this properly. So it's a very small group of companies. Just because the company's great at covering your car doesn't mean they know how to do this. That's the big takeaway. So, not all companies are the same. Not all of these are built the same. There are certain procedures. There's certain like writers and things like that make these work the way I've described them to work. So so how do they work? Who's using it? And what are the additional benefits? If we're going to buy a golden ticket, I hope it's got some benefits to it, right? But first, who's using it? So this is a chart showing the percentage of life insurance reserves that are held by the top 1% wealthiest people in the United States. And you can see it was at an all-time low in the early 90s at about 6%. And just from the early 90s to the early 2020s, it's all the way up to almost 35% of all the money in this category is held by the top 1% of people. And just to kind of see it with some context, this is all of the reserves held in life insurance policies. Almost 60% are held by the top 10% of people. And so I don't know about you guys, but being amongst the top 1% is a pretty sweet place to be, right? So what we like to tell our clients is we have to learn what the top 1% are doing if we want to benefit and build a legacy of like what they've built and live the lifestyle and be able to provide for our families the way that we want to. So it's important to realize that the wealthy people are not buying term insurance. They're not buying it for the insurance. What they're doing is they're buying it for the tax treatment. That's why they buy these types of plans. By that golden ticket, when you put your money into one of these accounts, that golden ticket says, hey, IRS, you can't treat this money the way you treat money from the banks and IRAs and in qualified accounts. We get special allowances by holding the money in one of these types of accounts. And it's not just people who are doing this. We definitely don't have time to go down this rabbit hole today, but if you guys do like going down some rabbit holes and learning, there's almost $200 billion from banks that they are stacking into these types of accounts. It's called BOLI, bank-owned life insurance. It's absolutely, it's amazing how these two competing financing monsters have really kind of cooperated in this extent. With banks and all their Federal Reserve limits and all the requirements to have a certain amount of money on hand, these types of accounts keep them liquid, earning interest, and safe from any kind of market downturn. This has been an excellent solution to all the issues that they saw in the early 2000s. So that is a very much a growing part of this industry. It's another example of how people who know how to make a lot of money are taking advantage of this type of strategy. So, as I mentioned earlier, this golden ticket I mentioned. So infinite banking is a concept using a life insurance policy and the cash value inside of it to earn better interest, learn how to protect your money from taxes, and leverage it into your business to accelerate what your cash can do for you. Now, this life insurance, there's the old type of life insurance. We call that death insurance, right? It's not all that exciting. When you pass away, you leave some money to somebody, right? The new type of life insurance, we call it living benefits. It's actually life insurance that you don't have to die to use. Now, if you do pass away, your infinite banking is going to have multipliers that pays out a lot larger amount of money than what you put into it to your family. That's already included with that golden ticket. But this plan also has benefits if you get diagnosed with a major illness like a cancer, heart attack, or stroke, critical injury, coma, severe burns, traumatic brain injury, paralysis, or if you actually become disabled or end up in a long-term care situation. If you can't complete 2 of the 6 activities of daily living, this will actually provide a guaranteed income for up to about 5 or 6 years, tax-free, that's included in the plan, that is actually baked into it. Does that? So I hope you guys are writing down good questions for us to cross over, because there's a lot of value there, and it's, if you're gonna have a golden ticket, you just want to make sure you have the best kind, right? You have all those extra benefits. So this is really why this living benefits conversation, not everybody is a fan of infinite banking. Not everybody's a believer in it. But even if you're not a fan of it, everybody probably should have living benefits. You don't have to, you can buy a very cheap and expensive term policy and get living benefits. The number one cause of bankruptcies, home foreclosures, and business failings is either the person or their spouse or one of their kids gets really, really sick. And I think pretty much every single one of us on this call probably knows someone who's been through a situation like that. The living benefits plans, they're actually cheaper than regular death insurance a lot of times. It's just it's a built-in rider that some carriers offer, but most don't. I mentioned 600 companies, only about 3 to 5 of them offer a living benefits feature in their plan. But it allows you to accelerate the death benefit of your policy so that you can cover your living expenses. Does that make sense? So about 80% of those, so 60% of bankruptcies was from a medical expense. About 80% of those people had major medical health insurance. There's just this huge gap in preparedness for a real traumatic or critical illness. On average, it takes 3 to 5 years to get better from. So that golden ticket, that tax treatment that we're paying for, comes with a lot of extra benefits. I wouldn't say free of charge because you have to buy the ticket, but it's not a bundle of benefits to receive. It's absolutely not unworth the money, I guess. So infinite banking, this is where we get real tactical and practical here. Okay. So you deposit the funds into the account, and we have to deduct the costs of that golden ticket. We have to buy the tax code that we want our money to receive, or we have to pay for that living benefits life insurance. That premium is deducted from our deposit. The rest of it goes into a savings account. Okay. And in that savings account, we have some options. This is the control I was talking about earlier. We can choose how we want our money to earn interest. These do fluctuate a little bit from year to year, especially when the Fed is playing with the interest rates so much. Currently, the fixed rate's between 4 and 5%. So when I'd say control, you can say, hey, I want my money growing at 5%, no fuss, tax-free, I'll take my 5%. Or you can choose to put it into the indexed option that has a 0% floor, so you're 100% safe. But if the market goes up, you can get up to around 10 or 12%, depending on the specifics of your plan. So over the last 5 years, we've seen about a 9% average. Over the last 13 years, we've averaged about 8.2%. Now, again, net of those insurance costs and the golden ticket expenses, we're trying to get our clients between 6 to 7 to 8% is what we're trying to average over a 10-year period. Okay, so we're trying to double, if we can double our cash in a safe way every 10 to 12 years in a really good market, 8 years. That's really effective motion for cash that's still liquid, and we can use it in our real estate business when that opportunity comes up. So this is where the infinite banking, the infinite part really steps in. So this is how we're earning interest on our money. And then we have borrowing options. Now, these loans, there are a lot of kind of wonky accounts out there that allow you to margin trade and loan against. And most of those accounts, what they do when you have those loans is the provision doesn't let the amount that you loaned earn interest anymore. It basically takes it out of the account. And now you have this negative motion on your account. That's not how this works. With a properly structured infinite banking, even though you've taken out that loan, you have options now. We can either do a standard loan at 0% interest, again, so it's 100% tax-free when it comes out, or we can do a participating loan, and that participating loan is going to average between 3.5% and 5.5%. On average, we're doing a little bit, we're probably less than half of what you can get on like a HELOC is usually where this account is sitting. So if we say we want a participating loan, let's just say our participating loan is 5% and we earn 9% interest, we're earning 4% interest on money that we've already spent. So our ghost money is growing back even after we've spent it, or maybe we've bought a property or something like that. I'm going to get some real life scenarios for you guys here. So this is a private money loan example. Let's say you have an infinite banking account and we have accumulated $150,000 in that account. Okay. And you get an opportunity. You're going to loan $100,000 of your 150 to a reliable source, and they're going to go flip a house. They're going to give you 10% return on your money. Okay. You're going to take a participating loan out of your account at 5% interest. All right. So you have your 150,000. We take a $100,000 loan out of our money to give to the real estate investor or the person who's going to flip the home. So we still have $50,000 left in the account. We have $100,000 that we've spent or we've loaned away. And at the end of the year, the $50,000 plus the $100,000 we got back from the PML deal, plus the 10% interest from the PML deal, and the 12%, which is 8% market return. Again, the average we've seen over the last about 15 years. So $12,000 minus the cost of that loan, you would come up with a total of $167,000 in that account from just cycling the money with your PML deal and while still earning money on that market. So what's really key about this is even though you gave your $100,000 out of the account, it left, you still earned a net 3%, $3,000 on that 100, even though you gave it to somebody else where it earned another 10%. This is how we can get our money working for us in multiple places at the same time. So here is a real illustration for one of my clients here in Omaha. This client had about $500,000 in his operating account. It wasn't even really an operating account. It was really his I'm waiting for the right deal account, right? And it fluctuated here and there, but he had about $500,000 that he kept in that account. So instead of keeping it in a savings account where he was earning about 3%, we showed him this infinite banking option. One of the rules with these types of plans, with these concepts, there's a lot of IRS code actually. And one of those codes says you can't put all the money in at one time. You have to put it in between 5 and 40 years. Okay. So it's either a little window or a big window. So we put the 500,000 we put in over 5 years. And you can see he put in 100,000. We deduct the cost of the golden ticket, we buy our tax code, we pay for the living benefits insurance. He has access to about $93,000 day one. That's what he has access to. Okay. Oh, I'm losing my clicker here. At the end of his fund, this is what we call the fund. It's fully funded. The way we built this one, it's fully funded after 5 years. He's walking out with $550,000. So he's earned 10% of the money he's put in over that time. A lot better than what you're going to see at the banks. Tax-free, tax deferred. He doesn't have to pay taxes on that $50,000. It's all accessible. And at every step along the way, he had access to about 90 to 94% of the money he's put in, he has access to right away. So, you've got your 500 and 0, you move over 1 to the infinite banking, you move over 2, you see how it goes, right? So you always have access to virtually the whole account. And by the way, he's walking around with $1.5 million of death benefit, living benefits. If he gets sick in any of these years, he might have put in 200 or 300,000. He has access to 1.5 million. If he passes away, his family is going to get a 3 times multiplier on that cash, again, tax free. If there's outstanding loans, that death benefit pays off the loan and the rest goes to whoever you name it to, whether it's your family, your company, whatever you name it to. It is a private agreement between you and a multi-billion-dollar financial company. The IRS can't get their sticky little fingers in it. If he doesn't do any real estate investing with this account, remember our rule of 72, this is going to average around a 5.5% to 6% return. So we get a couple more percentage points than what this is actually showing in the real world environment. Because of the insurance commission and the codes on these things, they only allow you to illustrate around a 5.7 to 6% return. But this gentleman, when he turns 65, let's just say he just leaves the money alone, his 500,000 looks about 1.1 or 1.2 million dollars. Again, tax free. So doubled the money. And you'll see the death benefit actually continues to grow even after that money has grown. So it is a cash multiplier kind of no matter what happens. With this particular account, if there's other provisions in the account, I mentioned the golden ticket. One of them is actually a lifetime income rider. He could turn on a lifetime income at age 65. It would pay out about $140,000 a year tax-free for the rest of this person's life. That's all included with our golden ticket. So not a bad price for admission. Now, not everybody has $100,000 to drop into an infinite bank, right? Not everybody's walking around with $500,000 in the savings account. This is kind of our Goldilocks scenario. A very common scenario is someone who maybe they're new to the real estate game. This is actually right where my business partner and I were just a few years ago. We couldn't put in hundreds of thousands of dollars, but we could put in a couple grand every month, and we could start building up that account that we use to then leverage into our first flip deal. And once we flip that house, we refund it back into our infinite bank, let it grow, let it prepare for the next deal that we want to move on. So whatever we have going on, maybe you get hit with a kind of a surprise year, you got a bit bad tax year. Aren't you thankful that you got money that's liquid and available and tax free, so you can pull it out, pay off the government who's going to charge you 8% per month compounding, which is unheard of, to get that off your back so you can get back to building wealth and not trying to pay back the man. But this is actually a young lady. She was doing about $2,000 per month. And the really cool thing about these plans, I talk about how important it is to build them and structure them properly, but you can build them with a lot of flexibility. So we put her in at $2,000 a month, but if business changes or income changes, she could drop that all the way down to probably about $400 a month. Now, she's not going to have it fully funded in 10 years. It's probably going to take her 15 or 20, but it allows you to do that because we know life changes and things change. It doesn't penalize you just because the fund that we anticipated doesn't stick. We're flexible with what that funding looks like. But we've got clients who are doing this as little as $300, $400, $500 a month, again, to get started so you can take a tangible step with your real estate business and getting into multiplying your wealth and building that business, the one that you've been dreaming about. So let me see if there's any notes on here. I want to make sure I don't miss. Talked about the death benefits. For her, she puts in 24,000. She's walking around with $1 million of coverage. Again, that's the living benefits coverage. Her left alone till 65, she's going to show an income of about $75,000 in retirement if she wants to use it for that. But you're not tied to it. You've got options. Good planning brings options. Good planning isn't I bought a thing. Good planning is, hey, I'm building something and I'm going to have options down the road. So I'm going to show you guys a screenshot of one of our different client. This is what their mobile banking app looks like. Okay. So this client's put in about they're putting in about $27,000 per year. You can see in this given year on the right-hand side, they have their money tied to the S&P 500 point to point, and they were credited 9.75% interest this year. So the majority of their money is in that S&P. It's not in the S&P, but it's tied to it. So whatever the S&P does, that's what it's going to credit the account for. So he earned about $22,500 in this year. He's got $252,000 available for loan, and he's walking around with a little over $3 million of death benefit on this plan. So about a factor of 10 times for this gentleman. If he passes away, his family's getting 3 times the money that he's actually built and saved in this plan. And he has all terminal, chronic, critical, injury, illness, all those things are built into this plan. So this client, he took out a loan for $229,000. He bought a flip. This client's actually in Dallas or Plano, Texas. He bought a nice flip. His interest on that loan was 3.5%. Now, this client gave us these screenshots. This was back in 2022. So again, we're probably seeing closer to 4.5 or 5 on the participating loan in today's rates. At this time, it was a 3.5% loan. And he doesn't ever have to pay that back if he doesn't want to. So it's not a required repayment, but the people who are using these plans the best are cycling that money and getting it to work for them in multiple places. So he flips that house, he refunds the money, he keeps it growing. That interest rate it accumulates over the year. So if you only have that loan out for 6 months, you're only paying half of that 3.5%. So
lot better than hard money.
Yeah. So common uses, real estate flips. I think that's the one that always flashes to me. It's the most obvious example of loan the money against yourself, keep earning interest while you're working on the property, flip the property, refund the account, keep it going, keep it going, keep it going. But you can use it for a real estate buy and hold because you don't actually have to pay that back. These accounts, I've seen clients withdraw the entire amount, just let them sit, and they will creep back over time. It takes time, but that interest will outpace the cost of that loan. So that money will kind of rebalance itself over time. Using it as a PML example, like I showed you earlier, any small business can do this. I'll tell you, I've got with my farming background, I've got a bunch of farmers and ranchers. They love this system, being less dependent on the banks. A lot of farms are multi-owners. We've seen banks call loans because one of those partners passes away. So building your business to be very anti-fragile, very tough, no matter what gets thrown at it. That golden ticket, sometimes people don't buy it for the insurance, but that insurance could be the thing that saves your butt. We like to use that as a multi-purpose fund. We like to call like our profit first account sometimes. We want to save money for the future, for retirement. A lot of business owners don't have retirement accounts because we can't tie money away for 60 years, most of us. So we can put it into one of these accounts and we still have access to it, but it can still keep us on track for retirement so we don't get left behind. We like to call it personal bank or generational bank. My favorite thing is we like to call it family banking. I mentioned I've got an 8-month-old. Well, maybe I'm just such a believer in it. I got started before we even had a little kiddo. But when kiddo gets old enough to buy a car, kiddo can take a loan from the family bank, and she can make payments back to the family bank where we control the interest, we control the rates, we control the value of that asset, but we can start building something different that my family never had growing up, that I think a lot of us are missing out on, is building that generational wealth. I can't think of a better way to do it. It just takes someone to get that ball rolling and get that started. If you get into like the whole Vanderbilt, Rothschilds, and all these things, there's all these YouTube videos. A lot of them build these family dynasties with whole life insurance and all these things. But you can do that on a reasonable, I would say even a better scale with these index accounts, because we can earn more interest than what you're going to get from like a whole life typically. A lot of clients will use this as a volatility shield for their market accounts. People who are really good with the market, buy low, sell high. They keep an infinite banking account handy, so when the market does drop, they can take that loan out, buy the dip, and rebalance and multiply their accounts over the long term. So, but that's kind of a wrap. I think that's the 101 on the infinite banking strategies. Again, guys, if you look up just kind of reviews over the infinite banking strategies, like anything, I think, especially in the financial world, you'll see as much good as bad. Every time I see a bad article, though, it pretty much sums up to bad advisor, inexperienced advisor, or sold the person something that they didn't want. Like that kind of solves basically every hit piece that's out there on this concept. Um, but all that done properly, it's an excellent tool to multiply your business and honestly to protect you from kind of the worst case scenarios. But Ted, we're right at 7:45, which is where I wanted to cap my talking. So love to dive into questions.
Yeah, so you got a handful of them here. I'll just start from the top. First question was from Joseph. He goes, "Have you worked with Transamerica company on any of their plans?"
Never worked with Transamerica. Nope, never have. Transamerica is a massive A-rated carrier. What we tend to see though is it's not. I don't. I don't think Transamerica is even built for an infinite banking type of account. What a lot of companies are selling is IULs, which you can do infinite banking with IULs, but it does matter which carrier that you're using. I don't think Transamerica is built for the liquidity that we need in order to do this properly. I hope that
Okay.
answers the question well.
And if it didn't, Joseph, just restate the question. We'll get right to it. Mike Sullivan, how long does the process take to move funds from the life insurance account on the investment account or to the
So
investment account?
that's one of the reasons why kind of I have my favorite carrier that we use. There where I keep. That's who I do my infinite banking with. It takes 2 days. So I have an infinite banking app. It's just like your mobile banking app. I just say, hey, I would like to take a loan out. Send $10,000 to my checking. I just hit a couple buttons, and the money's usually there in 2 days. I actually bought my wife a new car, which is not a good use of an infinite banking, but I bought her a new card with my infinite bank. Kind of had to scurry a little bit, but yeah, 2 days was all it took for the funds.
And Mike, you can ask these questions too if you rather. But second part is this similar to self-directed management 401k through an insurance company?
Oh, what was the term?
Is this similar to self-directed managed 401k through an insurance company?
No. So a self-directed 401k, that's going to be a retirement account. So that's going to have all the IRS kind of hooks that your typical IRAs are going to have. It's going to be the money that goes into a 401k is going to be tax deductible in that year, but then you're going to pay income taxes on whatever you pull out of it in the future. It's going to be tied up to your 59 and a half. This account is outside of those IRS rules. So we call these non-qualified accounts. Um, but yeah, that's a very stark difference between those two different accounts.
Do you need a mitigation company to apply and transfer funds from the life insurance account to the investment account?
No,
Like
you don't.
similar to a Pensco, he's asking.
Yeah, no. So it's actually so yeah. Like if you get into the real nitty gritty with these accounts, there is an options feature that's happening, but it's hyper simplified for account owners. All you do, I'm actually gonna so let me go back to my picture here. So when you open up that account and you've got the money in the account, you tell them, do you want the S&P or do you want the Hang Seng index or whatever index that you want, or do you want to just have the fixed interest for the year? You don't have to actually do any kind of moving or options calling or anything like that. It's all automatic.
What is the typical fee structure for transferring funds from insurance to investment? Is it based on amount or duration of investment?
So there in that piece there are no expenses. There's no expenses for the what you get credited from the account. This is where some I'm sure a lot of people here know Dave Ramsey. Dave Ramsey's the biggest debt guy. I was actually a Dave Ramsey SmartVestor Pro for a couple years. Um,
So was
it's,
I.
it's astonishing. Him and his team do not understand these accounts. They think that these are variable universal life. Variable universal life is very different. Any variable product, you have fees and expenses to actually have access to those securities, those mutual funds or those stocks or whatever that they're trading. I don't like using life insurance for any type of market growth oriented purpose. It doesn't make sense to me because I can get market a lot more efficient by going to the market. I do like using life insurance as a replacement for bonds and using for safe money for replacing banks and bonds. It's very effective. It's very efficient. But you're not actually putting money in those securities. Remember, your money's still in the savings account. But whatever happens in that index over the year, let's say it went up 5%, they say, okay, you take 5, you're going to get credited 5%. But your money was safe in the savings account the entire time. So you don't actually have any of that trading going on.
Okay. We got a couple more questions here. And what I meant by Dave Ramsey, I did his preferred realtor thing, not the
You did the
investors.
smart investor.
Yeah. Um, okay, so Joe says he's gonna reach out to you tomorrow. John says, "What's the best insurance company? Is Northwestern Mutual Infinite Banking worthy?"
So I'm going to be at risk of getting harassed by the Northwestern Mutual Mafia. Um, I'm not a big fan of whole life. To me, the whole life model is very niche, and it's usually for the what I would call ultra wealthy. The indexing like I said before, I like to have a little bit more horsepower with these accounts. I want to see margin between what I'm getting credited and what the cost of my loan is. The whole life and what Western Mutual really does is they really do things that match. Well, I can match, remember what I showed you, I can match with a standard loan at 0% all day long, which would be like being a whole life. But wouldn't you rather have the option? If I can average 6, 7, 8 net of all the costs, I'm gonna beat up a whole life, 9 times out of 10. But the ultra wealthy do like those fixed interest, or if you are a hyper uh hyper leveraged, or I'm talking like the money it goes out as soon as it hits, you're almost not even earning interest while it's there almost. The fixed option can make sense. We're not, again, this is my experience talking. This is my subjective advisor talk. We do fixed and we do index. We can do both. It's very situational though, and I think 90% of people are happier with that indexing strategy. But Northwestern Mutual, again, I'm not necessarily against Northwestern Mutual. They're a massive A-rated, secure company. I just think what tends to happen is companies that big and old tend to get kind of lazy with what they offer.
Okay, and Mike says he appreciates all your great advice. He goes to add to John's comment. Do you have a list of the insurance companies that allow this opportunity?
When you say allow the upper, we've got a short list. Like I said, it's probably 3 or 4 that we would trust with it. But as far as like picking the right one for each person is really, really specific. I would probably rather not spout out names on a generalized recorded webinar, but I'd be happy to kind of talk you through some advice and stuff privately though.
Okay, and yeah, and John just says he seconds that, and Mike says he wants to connect. So
Great.
awesome. Any last questions before we wrap up today?
I have a quick question here. Hi, Dylan. Thanks for the presentation and stuff, but I was curious, because I'm trying to understand how these insurance companies make money, right? Because there's got to be something to this where they're able to profit to this. Otherwise, I don't know how they would stay in business being able to do this. So what's kind of, I don't want to say catch, but there's got to be something that they drive profit out of. And you said that they don't really have fees or anything like that. So how does that kind of work?
Yeah, so and I want to be very Lane, good to see you again. Congrats on the engagement. I want to be very the words are tricky. So I like to say there are expenses, but what there are not are management fees or advisor fees. So you don't have any like trailing constant annual fees. If you run like a compound interest calculator and you do, let's just say 10% interest over 40 years and you take 1% off, you'll lose about 20% of your account value on a 1% trail. So what these companies do, what they make their money on is one, building their solvency. Just the more cash they get in, the more that they leverage, the more access that they have to their models and their investments. Most of these financial companies have 100, 200, 300 year time horizons, where most humans are looking at 25 to 40 years, right? Like that's so they have a much broader span of what they can do with their money over a long period of time. Now, in the very, again, kind of tactical hands-on, they're making money on the insurance, right? That golden ticket that you buy, you're buying a insurance policy. They make money when you buy insurance. There's also a premium expense when you put in money. There's usually some kind of cost associated with that money going in. Every plan is different, but they do show you right on those illustrations what those expenses are. Now, whether or not your advisor shows you is important. We always make sure we go through those expenses so there's no surprises. But yeah, they're making money. They're going to be okay.
Okay, awesome. I was just curious about that. So thanks for your time. Appreciate it.
Yeah, no, absolutely, man.
Yeah, thanks for chiming in there. Anybody else want to chime in with some questions here before we wrap up? I guess there's one here. It says, where do you stand with Mary Jo Ehrman? She is a whole life. Is that old tech? Mary Jo Ehrman. Do you know what that is?
How do you spell Ullman?
Mary Jo Irman. She is whole life. Is that old tech?
Okay. Yeah, and so I think, Ted, actually, you sent me a couple of resources when I was talking to you about the topic. I think what's happening, I think the reason why there's a lot more whole life advocates for whole life is because it is an older approach to this. I remember when I was in I think I was in high school. I remember a insurance guy coming by and talking to my dad about be your own banker, trying to sell a really big whole life policy. I there's kind of a conflict between what's mathematically best and what's best for each person, because you got to do what's right for you and what feels right to you. And for some people, they really like that security of a guaranteed interest rate. If you're a math and science, or typically, just again, the trends that we see, people who like the market, or especially like younger investors, they would much rather see their money on an index where they can see 9% interest or 8% interest or 7% interest instead of seeing 2 or 3 and a dividend every 2 or 3 years. So I wouldn't even call it old tech, because those companies they're trying to be competitive in the realm that they want to be competitive in. It's just not the ones that we would consider middle America or upper middle America very often. I hope
So
that.
he had a little bit more context. As he said that she's a very reputable podcast. Farming Without the Banking is her book.
Yeah, I just looked it up. I don't know much about her though. Actually, I'm gonna have to do more research on her.
Do a follow up.
Yeah, for sure.
Okay, guys. So we're kind of coming to the end of our hour, and we want to respect your guys' time. Do you guys have any other follow up questions before we wrap up today? And Dylan comes to a lot of our real estate meetups. So, if you don't get a chance to set up an appointment with him, his phone number is on the screen. Definitely take advantage of coming to our local events, Omaha RIA. You can go to omaharia.com to see all our events. Dylan's been at our golf event, our lunch event, and I think our last meetup also. So we'll see if that trend continues. Huh, Dylan?
Yeah, I'm unfortunately going to miss this next one. I'm going to be out of town, but I will be back on schedule after August. Summertime is just summertime.
Yep, we get it. I have no kids in the house until Monday.
All sorts of trouble.
Anything else, guys, or anything, Dylan, you want to follow up?
Yeah, just again, guys, thank you so much for tuning in, giving me the opportunity to talk to you guys. I really love this Omaha RIA group. I think it's really cool what's Ted's building, and I love being a part of it. So there's no bad questions. Lane, I love the question. How do you guys get paid? It's a really important question on how financial companies or finance guys get paid. So there's no question you're not supposed to ask. So I want to be an open book. I want to be a resource for you guys. I'm going to be around for a while, so love to connect.
Carmela just asked if you have time to talk tomorrow.
On the phone?
Carmela, you're muted. Yep, on the phone tomorrow.
Yeah, if you Carmela, if you see my number on there, just shoot me a text and we'll get a time. I'll be driving. My wife and I get to go to the Black Hills. It's kind of our summer tradition. So we'll be on the road, but I'd be happy to connect with you.
Awesome. Carmela, thanks for jumping on. Thanks for all the great questions. You got tons of thank you here in the notes. We appreciate you guys very much. And then if you guys need to see a recap of this, if you joined late, you can go to our our RIA Radio YouTube channel. We will have a copy of this on there by tomorrow. We'll share the link, or to go to our omaharia.com. We did a live cast of this. Usually it can be a little jittery every once in a while, but a nice version will be on our YouTube channel. And John, thank you for the back end and the production side of this. We appreciate it so much. Dylan, you kick butt, man. Appreciate you.
Yep. Thanks, Ted. Thanks, everybody.
Bye, guys. Thank you.
Thanks, Dylan.